Hello, everybody. Thank you so much for being here with me. My name is Cheree, and I am your favorite lender here over at SimpliFunded. You can call or text us at 703-951-4419. And shout out to Facebook and Instagram because I know that they were out of commission earlier today, but it looks like we are all back online with a couple of our favorite social media channels. So, yeah. But again, 703-951-4419. Today's conversation is all about your BRRRR. BRRRR stands for buy, renovate, rent, refinance, and repeat. And a lot of people are using the BRRRR strategy in order to gain wealth, in order to do very well with regards to building your real estate rental portfolio. And I wanted to show you a quick example of how you can fund your BRRRR strategy. So I'm going to share my screen really quickly and present this, and we are going to get started today. So again, my name is Cheree. I am the area director of SimpliFunded. So you can again call or text us at 703-951 4419. So, first question you may be asking is what is the BRRRR method? You probably have heard about it before, but you're not really sure when to use it, how to use it. So, I want to go over what it is, give you an example, and give you some pros and cons. So that way you are making a smart decision as you are building your wealth through the power of real estate. So, BRRRR is an acronym that stands for buy, renovate, rent, refinance, and repeat. And what happens is it's a way for you to build your rental income, your rental portfolio, your passive income without any ceiling on the number of properties that you are able to purchase. So, what happens during the BRRRR strategy? The first thing is in step one, you're going to buy a property, one property. You're going to you're going to repair or renovate the property, and then you're going to rent out that one house. And then you're going to refinance that property, pull your cash out of that property, hopefully all of the cash that you initially put into that property, and you're going to buy a second property. And you are going to repeat step one, meaning that you're going to buy it, you're going to repair that second property, and you're going to rent out that second house. And then you're going to do that a third time, a fourth time, a fifth time, a 10th time, a 20th time. And you could potentially take the original capital that you used for that initial house and buy multitudes of houses. That's what the BRRRR method is. So it's not all roses though, and candy and lollipops, etc. There are some cons with regards to the BRRRR strategy. So let's first of all talk about the pros, and then we'll go to the cons. So one great pro of the BRRRR strategy is that there is the potential for consistent cash flow, especially if you have a good tenant. You can, if you buy these properties right, you can have equity on the first day when you actually purchase the property. Another pro is, of course, tax savings, potentially through depreciation. You could also have appreciation as well of the property, depending on where you're purchasing that property. Another pro is you can purchase one property, and then as you refinance it, you take that cash out and you can put it to the next property and the next property and the next property. So, in other words, you can continue to use that first cash contribution in order to grow your portfolio. Next pro is you can buy an infinite number of properties with that same first cash infusion as long as you're purchasing the properties right. So ultimately, with the BRRRR strategy, there is a lot of scalability. So, what are some of the cons? Because again, not everything is, you know, uh, not everything is for everybody. So, with regards to this strategy, you do have two rounds of closing costs. One round when you buy and renovate the property, and then another round of closing costs when you refinance the property. Now, I just closed a loan with a borrower, husband and wife team, where they will only have one set of closing costs because they got a renovation loan. Those are possible as well, but you definitely want to touch base with me with regards to that. They're not going to be able to refinance the property, though, in order to get their money out immediately. Well, they can at any time because with the type of loan that they have, there's no prepayment penalty. But, you know, once they refinance, that is going to be a second round of closing costs. The rental income may not be high enough to refinance. That's another thing that we need to be aware of. Refinancing may take some seasoning. Oftentimes, you have to, you may have to own the property for 3 to 6 months before you're able to refinance the property out. The interest is higher than primary residences. So anytime you buy an investment property, you're going to pay a slightly higher interest rate than you would if you owned that home and you were living in that home. And depending on the lender that you go to, sometimes they will have a cap on the number of loans that they're willing to give you. So that's why you come to somebody like me, who is a mortgage broker, who can make sure that we do not run into that ceiling or that cap issue for any of my borrowers here. Next is, where do you get the money? Well, obviously you come to SimpliFunded, hopefully in order to get the funds for your BRRRR strategy. But let's use an example here. Let's say that you're purchasing a property for $50,000, the construction costs are $20,000, and the after renovation value is going to be $100,000. So we just want to use very simple numbers here, just so you can see a little bit with regards to how this works. So you're going to buy this property, you're going to renovate it, and then you're going to rent it out. Okay. So a hard money lender, which we are hard money lenders, especially in the Metro DC area, will give you a quote. They'll give you an offer. They'll say, hey, we will offer you $55,000 loan for you to purchase and do the construction, but you have to contribute the rest of the money. So you're going to contribute $15,000, and we as a hard money lender will contribute $55,000 for you to get this property. And obviously, you have $70,000 all in. The purchase price and the construction is $70,000. The after renovation value is $100,000. So you are getting this property at a 70%, 70% of the value. So you actually have really bought this property at a really great price. So once you have signed up, gotten hard money, closed on the property, renovated the property, you're going to need to get renters in the property. And the key is, when you refinance, you need to make sure that the rental income that you're getting on that property, for every dollar you're going to pay in a mortgage, so in principal, interest, taxes, insurance, and any kind of HOA or condo fees, you need to have at least $1 in rental income coming from the renters. So you're going to work with your realtor or your property manager. And the best thing to do before you get started with this whole strategy is come and speak to someone like me, so we can run through all of these numbers from start to finish at the very beginning to make sure that you are going to successfully be able to refinance this property and repay that hard money loan back. But now you're ready to refinance this property, right? So you can refinance usually at about 75% of the value of the property. So that $100,000 property, you can pull out $75,000 in the refinance. These are 30-year loans. You may have heard of these types of loans. They're called DSCR loans. That stands for debt service coverage ratio. And again, for every dollar you're receiving in rent, take a step back. For every dollar you're paying in principal, interest, taxes, insurance, and any HOA fees, you must have at least $1 in rent for this to work. You can close these loans in LLCs unless you're going through a traditional lender. A lot of traditional banks or big banks don't have these products. So again, you need to come to someone like me in order to get these loan products. But the other thing is the rates are going to be slightly higher than your traditional lenders. Again, they're going to be slightly higher than your conventional loans, and they're going to be slightly higher than your loan for your primary residence. But the great thing is you don't have to prove any kind of pay stubs. You could be unemployed and get these types of loans. So these are the DSCR loans. So you would refinance this property for $75,000. You would repay the hard money loan, which was $55,000, and you could get cash out of $20,000, and that $20,000 represents the amount of money that you initially put in to purchase the property. So you get that money out, and you can BRRRR, meaning you can repeat the last R, repeat the whole process over and over again, if and when you're able to pick up the houses at a certain cost. So if you want to know more, you want to have a conversation with me, a free consult is available to you. Again, you are able to call or text 703-951-4419, and I would love to serve you. That is it. Thank you so much, and I will talk with you tomorrow. Take care.